Welcome back. On a night where shares are in the spotlight, Switzer regular and independent investment expert Roger Montgomery joins us for a look at 5 stocks that pass his valuable cash flow test and 5 that don't. Will your portfolio pass? Welcome, Roger.
Nice to be back.
All right, mate. Let's go quickly talking. We often run out of time because we joke around and we carry on.
Well, for people who weren't tuned in a fortnight ago when I was on, and I can't imagine who that would be.
There could be some new ones. Yep.
Well, they're going to the footy tonight. Some of them might be, unfortunately.
Don't talk about the weak opposition.
Yep. What we decided to do was we talked about how to calculate cash flow. So what I did is I basically summarised the chapter from my book about that there's a very quick back-of-the-envelope way to work out whether or not a company actually makes money.
Yep.
So there's plenty of companies that report that they make money, so they have an accounting profit. Yeah. Qantas is an example. But really their economic profit doesn't exist, so they don't actually make a profit when you look at the cash flows.
Negative. Okay.
And what you'll see is when a company is cash flow negative, when it's business and all of the commitments it needs to make to continue running that business, so if it needs to update plant and machinery or it needs to buy new stuff or it wants to expand forever and a day, if the business itself can't fund that, then there'll be a funding gap. And that funding gap needs to be made up by the company either raising capital or borrowing more money.
Yeah.
So what I decided to do was pull out 2 groups. Yeah. So you asked me for 5 companies that had poor cash flow compared to their reported profits. Yeah. And what I decided to do was look at companies that reported poorly either in the last year or over the last 3, 5 or 10 years as well.
Good perspective.
So we can look at aggregate numbers as well.
Yep.
And then 5 good ones. Okay, so I'll start with the poor ones, I think.
Yeah, let's start negative and finish on a positive high.
Now, let me say, some of these businesses I know nothing about. Why? Yeah. Because of the metrics that they produce. I just never look at them.
Yeah.
But
they don't pass the first test.
They don't pass the first test.
Okay, let's go.
So the first one's Naomi Cotton.
Yeah.
Now, Naomi Cotton, to give you an idea, they reported a profit in aggregate over the last 8 or 10 years of $70 million. But their cash flow from operations was minus $70 million. So it's almost a 180-degree flip over, or more than. So they're making a loss over the last 10 years. Now, in addition to that $70 million loss from their business, they've gone and spent another $30 million or $27 million over the last 10 years on stuff. Yeah. So maintaining their business or new this, that or the other.
Capital and whatever.
So that means after investing, they've got a cash flow loss of almost $100 million. Surprise, surprise, they've raised $108 million in debt over the last 10 years. So that's how they've funded that gap. Now, if you're looking to buy businesses, there'll be lots of brokers that'll put out a report about a company and they'll say, we think this is a discount to its assets, or we think that that this thematic event is occurring, you should buy these stocks.
Yeah, and effectively that investment, the 20 or 30 million whatever they invested, is going to have a great impact on profit and returns.
Possibly.
Yeah.
But if there's not a demonstrated track record of that, and over a long period of time there isn't, then I'm suggesting that those promises might be a bit hollow.
Okay.
And you need to be very, very careful.
Let's go to the next one.
Okay, next one. Yes, I'm hearing you. All right, so the next one is Funtastic. So if we look at the last year's results, okay, they lost $3.6 million. But that's what they reported. Yeah. But their actual cash flow loss, the cash from operations, was about $6 million. Then they spent $11.5 million on stuff. So their cash flow after investing was about an $18 million loss. So they had to borrow an extra $17 million.
And it's Funtastic, the Fantastic furniture?
No. Fantastic's fantastic. Funtastic's the toys.
Yeah. I want to make that point in case people got you wrong.
There's Funtastic and there's Fantastic. Now here's an interesting one. I'll just look at the last year's results again. This is Lend-Lease. Lend-Lease reported a $345 million profit after tax, but their cash flow from operations was $200 million or $220 million. So it was about $100 million less. Then they spent $300 million on stuff. So their cash flow after investing was a loss of about $90 million. Then they paid dividends of $126 million.
Which made the shareholders like them.
Yeah, so the shareholders were happy. So they had to raise $800 million of equity and they paid off $10 million of debt. Now, arguably, some of that equity that they raised is for something else in the future, but it's also to cover that gap.
And the analysts have been pretty positive about Lend-Lease lately, haven't they?
Well,
Roger?
You know what? When you've got when you look at your paddock, and you've got lots of rotting vegetation, then anything that's a little bit not rotting you know, it looks good. It's all relative, isn't it?
All right.
All right, now the next one is, I'll talk about this one because we're running out of time.
Yeah.
This was Nexus Energy, the code's NXS.
Yeah.
But we actually have a look at what they've done. They reported a loss of $23 million in aggregate over the last 10 years.
Right.
But they've actually lost cash flow from operations $70 million, and then they invested another almost $700 million. So in addition to losing money from their operations, they've gone and bought stuff, and as a result, they've had to raise capital of $766 million.
So reminds me, this is Nexus Energy.
This is Nexus Energy.
Okay.
Now, they may end up doing something. So they're the bad ones. Now, I've got a couple of others, but we're running out of time.
Okay.
So
go to the goodies.
Go to the good ones. So